Conversation, and within hours, markets reacted the way they always do when they think the reserve system is being race-scored. Gold moved first, the dollar got jumpy, rate expectations shifted, and the word BRICS stopped sounding like a social media talking point and started showing up in the kind of language institutional analysts use when they believe something structural is changing. Let me tighten this before it turns into internet fiction. The Federal Reserve doesn't publish a secret BRICS plan like a movie villain. That's not how central banking works. What it does is signal through carefully chosen language, through risk framing, through the way it talks about stability, liquidity, and the global environment. Markets don't need a formal announcement. They translate signals into probabilities. And when enough big players translate the same signal the same way, the repricing becomes real. Here's the mistake most people make. They think this is a gold story. It isn't. Gold is the thermometer. When confidence drops, gold doesn't cause the problem, it reveals it. And they think this is BRICS hype. It isn't. BRICS is just the label people attach when they're trying to describe a broader idea, large blocks preparing for more diversification, more fragmentation, and less automatic dependence on one center of gravity. So the real story is confidence. Reserve status is not enforced by a global law. It's a confidence equilibrium, a shared belief that the same system will keep working tomorrow the way it worked yesterday. When that belief is stable, the world is predictable. When it starts to wobble, everything gets repriced at once. I want you to hold one word in your head as we go: map, not a geographic map, a reserve map. Who holds what? Who buys what? Who reduces exposure quietly, month after month, because reserve shifts don't happen with a parade, they happen with allocations. And this matters to you directly if you live in any economy where borrowing costs and import prices touch daily life: mortgages, credit cards, business loans, the cost of goods that move across borders. When reserve confidence changes, financing conditions tighten, and those conditions don't stay on trading screens, they land in your monthly budget. In a moment, I'll show you what market skied on the specific shift that made this feel like active planning, not background theory. But first you need the frame. Global finance is plumbing. A few pipes carry the pressure: liquidity, settlement, demand for safe assets. If alternative pipes are being built, even as a backup, volatility rises because certainty disappears. Markets don't wait for permission. So what exactly happened today, and why did markets treat it like a map shift? What happened today wasn't an announcement. It was a signal, and markets translated it immediately. To understand why, you have to understand how the Federal Reserve actually moves the world. The Fed doesn't only set interest rates, it sets expectations. It shapes the framework capital uses to decide what is safe, what is risky, and what is worth holding when uncertainty rises. That's what people mean by forward guidance, not a promise carved in stone, but a structure markets convert into probabilities. And today, something in that Fed-linked communication, whether it was a set of remarks, minutes language, a report, or risk framing in official context, was interpreted as upgrading a background idea into a live variable. Not BRICS is replacing the dollar, not the dollar is collapsing, but something more realistic: that diversification. Planning and fragmentation risk are accelerating, and the timeline may be shorter than the public assumes. Here's the mechanism. When investors start believing the reserve environment is getting less predictable, they demand a higher risk premium. They want more compensation for holding assets that depend on stable liquidity and stable confidence. That shows up first in the price of money, bond yields, and rate expectations. It shows up in currency markets because FX is where confidence gets repriced fastest. And it shows up in hedges because when people can't quantify the risk precisely, they reach for insurance. That is why gold moves in these moments. Not because gold knows something mystical, because gold is where uncertainty gets priced when confidence is the question. And this doesn't require a conspiracy. You don't need a secret meeting to get diversification. Central banks manage concentration risk the same way any serious portfolio manager does. They hedge political exposure. They reduce single point of failure risk in settlement and liquidity. They plan for scenarios where access to reserves or payment rails is constrained. Those are normal incentives. What changes everything is when markets believe those incentives are shifting from long-term gradual to active and ongoing. This is also why the Fed's role is uniquely sensitive. The Fed is not just another institution commenting on global conditions. It is the anchor markets associate with dollar liquidity and system stability. So when the anchoring institution signals higher uncertainty, even subtly, the reaction can look disproportionate. But it's not. It's rational positioning under uncertainty. And here's the communication risk. When official language remains calm and carefully ambiguous while market prices are signaling that expectations have changed, the public gets misled. Not intentionally, not necessarily, but functionally. People don't feel reserve diversification in real time. They feel it later as higher borrowing costs, price volatility, and tighter financial conditions. This isn't about one document, it's about what the market believes the timeline is. Now let's talk about the dependency most people miss, because that's where a small shift becomes a cascading cost. That dependency is the price of money and how much the world is willing to fund the US system at low cost. Because when people talk about reserve status, they often treat it like a symbolic trophy. It's not, it's infrastructure. The dollar system functions smoothly because there's a deep, predictable buyer base for dollar assets, especially U.S. Treasuries, and because the settlement ecosystem around the dollar is trusted, liquid, and familiar. That trust is what keeps the machine quiet. When reserve confidence is strong, global institutions don't just like the dollar, they allocate to it by default. And that default behavior matters because it keeps yields lower than they would otherwise be. Lower yields don't stay inside government finance. They flow outward into everything priced off the risk-free rate: mortgages, corporate borrowing, municipal financing, consumer credit, and the cost of capital for the entire economy. So when we say markets reprice the timeline, this is what they're repricing: the possibility that the default buyer base becomes less automatic, not gone, not collapsing, just less predictable. And when a buyer base becomes less predictable, the system demands compensation. That's the risk premium, and it shows up as higher rates. Here's example one, the one most people feel first. If the bond market starts demanding even a modestly higher yield to hold U.S. debt because it senses higher structural uncertainty, borrowing costs rise across the board. Mortgage rates don't wait, auto loans don't wait, credit card APRs don't wait, small businesses trying to roll a credit line don't get a grace period. The repricing moves through the system faster than most households can adjust. Example 2 is slower, but heavier. Higher Treasury financing costs mean fiscal pressure. More of the budget goes to servicing debt. That reduces flexibility, less room to respond to a recession, a crisis, or a shock without either cutting elsewhere or borrowing even more at worse terms. Over time, that becomes a constraint on national power in a way that doesn't show up in a headline, but absolutely shows up in outcomes. So what does no plan B look like in a reserve system? It doesn't look like a dramatic announcement. It looks like a stress event colliding with hesitation at the exact point where the system expects automatic support: a geopolitical flare-up, a banking shock, a sudden political uncertainty that makes institutions reassess exposure. Any one of those things can be absorbed when the reserve map is stable because the buyer base behaves predictably. So the failure mode is simple. A shock arrives, and at the same time, the reserve system stops behaving like automatic infrastructure. Liquidity thins, bid-ask spreads widen, volatility jumps, yields rise quickly. The dollar can swing sharply in either direction: strength on flight to safety, then weakness if confidence in the system itself becomes the question. And that volatility is not a trader's game. It is financial conditions tightening in real time. So in the short run, when the map shifts and the system is stressed, the adjustment happens through pain repricing. That's what no plan B means. The system doesn't have a spare engine. It has one engine that runs on confidence, and when that confidence becomes conditional, the only immediate stabilizer is price. Higher yields to attract buyers, wider spreads to compensate for uncertainty, more volatility to clear the market. Human stakes are not hypothetical here. Picture a mid-sized importer locked into delivery contracts while financing costs jump and FX volatility spikes. Their margins don't adjust, they break, or a household on variable rate debt watching payments reset upward just as prices for essentials rise. The mechanism is abstract, but the consequences are not. And this is the point where you stop watching speeches and start watching validators, people and institutions who live inside the plumbing and can't afford to be wrong. Because when they speak, they're not performing politics, they're signaling risk. That's why the next part matters. What credible operators and markets did next tells you whether this was noise or the start of a real repricing cycle. So what did the credible operators do next? They didn't argue, they priced it. Because in markets, the people who actually carry risk don't get to wait for the narrative to calm down. They have to decide right now whether the system is behaving like stable infrastructure or whether it's starting to behave like a stress test. And when that question shows up, the first response isn't a press release, it's a position change. This is where a validator matters, not because one famous person controls markets, but because seasoned operators have a different instinct. They separate political noise from structural risk. They don't ask, who's right? They ask, what does this do to incentives, liquidity, and credibility? And when their language shifts, it's usually because they think the map itself is being redrawn. Here's how one veteran macro investor has put it in plain terms. You don't need the dollar to lose reserve status for the system to get more expensive. You only need the world to treat dollar stability as conditional. When stability becomes conditional, it gets priced. That's the whole story in one framework. The key isn't a headline about BRICS. The key is the word conditional, because a reserve system is a confidence architecture. It works because enough large players assume the default will keep being the default. Once that assumption weakens, even slightly, you start seeing regime change behavior in basic pricing signals. Not because one chart proves everything, but because the direction starts to align across markets in a way professionals recognize. Gold strength is one signal. It's where uncertainty parks when it doesn't know what else to trust. Bond repricing is another. It's where the cost of money updates first. Currency volatility is the third. It's where confidence gets marked to market fastest. And you don't need these moves to be historic for them to matter. You only need them to start behaving differently at the same time the story changes. That alignment is what makes serious institutions pay attention, because when narrative and positioning move together, they tend to reinforce each other. Now let's pay off what I promised. In the opening, because this is the hinge. The panic wasn't triggered by a line like BRICS will replace the dollar. Serious institutions don't speak that way, and markets don't trade on slogans. What flipped this from theory to planning was the shift in framing from remote possibility to active scenario, from something you acknowledge to something you hedge, from background noise to a line item in risk models. In other words, the market didn't hear a prophecy, it heard a timeline. And once markets hear a timeline, the map changes, because reserve diversification isn't about ideology. It's about risk management. If a reserve manager believes fragmentation risk is rising sanctions risk, settlement risk, political risk, they don't need to become anti-dollar. They only need to become less concentrated. That one adjustment, repeated consistently, creates persistent pressure at the margin. Here's the uncomfortable part most people miss. Reactions like this don't unwind cleanly once they become embedded in expectations. Once participants start treating accelerating diversification as a real scenario, hedges don't vanish overnight. They get rolled, they become policy, the baseline uncertainty becomes normal. That's why this matters beyond market chatter, because uncertainty doesn't stay contained in trading desks. It bleeds into lending standards, it shows up in corporate financing decisions, it pressures central banks. Even if the real-world reallocation is slow, financial conditions can tighten fast. So where does that leave us? If this is really a confidence system and it is then pretending the map isn't shifting won't stop the repricing. The only stabilizer for a confidence architecture is credibility, clarity, consistency, and the sense that the anchor institution isn't speaking in riddles while the market screams in numbers. And that brings us to the final point. If this isn't about gold and it isn't about headlines, then what is it about? It's about whether the U.S. can maintain the credibility that keeps the reserve map intact, or whether we're watching the beginning of a slow reallocation that becomes irreversible simply because it becomes routine. If this becomes routine, it becomes irreversible. Because what you're watching isn't a headline cycle. It's the normalization of a new assumption, that reserve confidence can be treated as conditional, and that major blocks are planning around that possibility. And once planning becomes standard, it moves on process. So here's the thesis, once clearly. This wasn't about gold. This wasn't about slogans. This was about reserve confidence and credibility. Now the core question, if reserve confidence can erode quietly, what stops a slow drift from turning into a fast run? The answer is credibility, predictable policy, institutional clarity, and enough consistency that major holders don't feel compelled to build alternatives. Because once alternatives exist, even as backups, they change behavior. And behavior is what makes a reserve map real. Here's the mechanism in 3 steps. Marginal diversification doesn't need to replace anything to matter. If large reserve managers reduce new dollar allocations at the margin, the system compensates through price. That price is a higher risk premium. Higher risk premium means tighter financial conditions, higher yields, more FX volatility, more expensive hedging. And once that becomes the baseline, you don't return to the old world easily, because the old world was built on automatic assumptions. And that brings us back to the motif map. The reserve map isn't a chart someone posts online. It's a pattern of behavior among the institutions that fund the system. The dollar system is financial plumbing, deep pipes, trusted rails, routine flows. It doesn't become fragile because someone makes a speech. It becomes more expensive. When enough participants decide they need a second set of pipes, they didn't have to announce a new order. They only had to move the map.